Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Alimentation Couche-Tard is one of the best performing stocks on the TSX today after the Canadian convenience store operator posted profit that topped estimates in its latest quarter. Revenue in its Canadian and U.S. merchandise segments also beat expectations. The Circle K owner says the quarter was also boosted by acquisitions despite lower fuel prices and wholesale fuel revenue. Shares of the H&R REIT are also getting a lift. The Canadian Real Estate Investment Trust is selling retail and office properties in Canada and the U.S., amounting to about $1.5 billion U.S. H&R says the step is part of its portfolio strategy. Earlier this month, the company ended its strategic review process without a sale. It also reported operating income that missed estimates. Shares of Best Buy are moving higher today after posting better than expected results. In its latest quarter, the electronics retailer posted profit and revenue that surpassed estimates and also saw sales in its U.S. and international segments top expectations. Best Buy also boosted its full-year profit forecast and says consumers are still willing to spend on new tech products. Taking a look at the markets right now, you can see the TSX inching up towards record territory again. It's up 0.48%. And south of the border, seeing some similar numbers except for the NASDAQ, of course, and that's what's going on with the tech with NVIDIA. But right now, the S&P 500 up about a wash right now. Dow Jones up by 0.6869, and NASDAQ is down 0.44%. NVIDIA shares are down on reports that Meta is considering using chips designed by Google. Let's get more on this with Jack Manley. He is the global market strategist at JP Morgan Asset Management. And Jack, thanks very much for joining us.
Yeah, well, thank you for having me, Roger.
A bit of a shakeup today with what's unfolding. How are you reading all this?
Yeah, I mean, I think what's going on today really underscores a couple of things. I think it underscores the risk of making any, single big concentrated bet on any one particular security. But it also underscores, it really highlights, frankly, something that we see happen over the course of many technological, let's call them revolutions, right? This idea that leadership is going to pass from one company to another company as that technology matures. Now, in the past, that leadership change has typically gone where the baton is passed from what's referred to as the makers to what's referred to as the takers. The makers being the companies that are actually laying the groundwork, building the infrastructure. The takers are the upstarts, the newcomers, the ones that kind of show up out of nowhere, take that technology and revolutionize a business model. Probably not as much of a risk of that happening right now in this market. And these companies have a lot of cash. They're pretty loosely regulated. They can gobble up small upstart companies very, very quickly. But certainly some risk of the big players sort of jockeying for pole position. All it takes to get good in this space is money, and we know that these companies have plenty of that. So not particularly surprising. For me, it was more of a question of when, not if, that something like this would happen.
Now, does this leave NVIDIA kind of on the outside looking in, or is there still lots of room?
I wouldn't say that necessarily. There is so much money sloshing around out there in this space. There is so much fiscal support, administrative support for AI and the build out, particularly in the United States. I think there are plenty of opportunities for a lot of different players in the AI world to continue to make quite a bit of money. So I wouldn't say anybody's being shoved out at the moment.
So there's lots of room for that. Okay, I want to move over to talking about the GDP. The numbers are coming out for Canada this week, and what a big difference. I was looking, the U.S. is tracking at close to 4%. We're likely going to be flat.
Yeah.
They're leaving us behind.
Yeah, I mean, first of all, envious that you guys are getting your numbers out on time. We were supposed to get our third quarter print out a couple of weeks ago, and that did not happen, obviously, because of the shutdown. But to your point, we do have some insight into how these numbers are shaping up. And third quarter growth in the U.S. is looking to be fairly strong, close to 4%. Third quarter growth in Canada looking to be pretty close close to flat. This divergence here between these two economies, something that we've seen happen for quite some time at this point. Long before, actually, the trade war kicked off back in April, there has been pretty significant divergence between the economic performance between these two countries, really going back to the pandemic. And I think what that does, right, is underscore, again, some of the risks, headwinds, I suppose, that the Canadian economy, and in particular the Canadian consumer, is facing right now. We know that the transmission mechanism for higher interest rates is a lot more effective here in Canada than it is in the United States, in the sense that mortgage rates get refinanced very quickly. Homeowners see those higher rates passed on very quickly. That's a depressive force. We know that policy change out of Washington has been a source of confusion, of course, but also a real negative in terms of economic activity. The Canadian economy very tightly levered to the U.S. economy, 25% of GDP coming from exports, 75% of those exports headed here, or rather headed for the States. And then, of course, you have a labor market that's considerably slacker here in Canada than it is in the U.S. You know, what we're going to be seeing this Friday with GDP is, I think, confirmation of a story that we've been telling for a while now.
And is this a transition, does it feel like, for Canada, or is this something that we still haven't figured out?
I don't think anybody's really figured it out at this point. I mean, the rules of engagement, particularly as they relate to trade, are touch and go. They change pretty frequently. And when I think about what 2026 has in store, it's going to be more of this policy noise. Now, Washington, for a long time, was being pretty noisy. Ottawa may get in on the party as we move through next year. But I do think that's going to be one of the big themes for investors in 2026 is a lot of policy change continuing to inject uncertainty, I suppose, into the macro landscape.
And then in the middle of all this, you have the TSX outperforming the S&P 500. We'll just throw that in there.
Yeah, I mean, it's kind of interesting, right, that the divergence from an economic perspective has been a negative one for Canada, but the divergence from a markets perspective has been a positive one. And, you know, I think it is a good reminder that the economy and the stock market are not always mirror images of each other. It's tempting to think of them like that, but they aren't necessarily mirror images of each other. But I think it also helps to tell a story of, you know, a Canadian equity market that's caught a bid on a couple of things that have just worked really nicely this year. We know, for example, the valuations were a compelling story at the start of 2025. The TSX trading cheap relative to its history, certainly cheap relative to its U.S. cousin. So valuations ending up being a nice tailwind for performance. We also know there have been some very sector-specific, almost idiosyncratic stories that have driven the TSX higher. You got gold prices up, like 40% this year, a huge boon for miners, the materials sector doing quite well. We know the interest rate environment has gotten a little bit more benign for banks, at least. Net interest margins have improved. It's been great for financials. You know, I like what's happened to the TSX this year. I think it makes a whole lot of sense. What I would be cautious of, though, as we look into next year, is reading too much into the outperformance from 2025 and assuming that it's repeatable, that it's replicable in 2026. I am not looking for another 20+% return year out of the TSX, and I'm not looking for Canadian equities to outperform their American counterparts next year.
Okay, we're going to leave it there. Jack, thanks as always for joining us.
Thanks for having me. Great to be here.
Jack Manley is Global Market Strategist at JP Morgan Asset Management. Up next, Zoom released its earnings that beat in profit and revenue. We'll unpack those numbers after the break. Well, shares of Zoom are up after the company reported a beat on profit and revenue. And as analysts are looking at their development in AI features for sustained revenue and profit now that demand for the communications platform has dipped since COVID. Here to talk more about it is Catherine Trebnick, Senior Research Analyst at Rosenblatt Securities. Catherine, thanks very much for joining us.
Well, you're very welcome. Thank you for having me today. And happy Thanksgiving.
We will take it. We had our Thanksgiving a month ago, but we always want to celebrate with more turkey and with our good friends to the south of the border. So.
Okay, thank you.
Zoom, some good numbers to see there.
Yeah, they really had they delivered a clean sweep across revenue. They beat by 60 million, EPS by 8 cents, margins, my margins 130%. and then basis points, and then free cash flow at 50% free cash flow margins. I mean, it's incredible. I think it's really a quarter that shows that the company's is showing real product momentum, real AI adoption, and their maturing channel strategy is really kicking in. So, plus they raised guide for the year across all those key indexes.
And what are some of the new products that you're liking and are helping drive this?
Well, okay, so roughly I'd estimate 20% of the revenue is with the cohort group that they've been aggressively developing. So the Zoom Phone is roughly 10% of revenue. That's growing roughly 15% year over year. The newer product introduced in 2023 is the contact center. They discuss that in growing in high double digits, so I'd say roughly 90, probably good 100% to year over year. And then the contact center is really one of the ones that I think is really helping them drive the AI innovation. They talk a lot about how their newer products are on top of their contact center and helping them win deals and position them. And then they have what they call Zoom Companion AI that quadrupled year over year. They landed 2 new customers with that, expanded them actually with Oracle and Salesforce. And then the other product is Workviva, and that product they've actually partner or are taking a lot of Meta's customers and transferring them over. So those are 3 of the main ones that are, I think, driving the growth. And then when you talk to the channel and you ask them, how are they really positioning, you're hearing that that the R&D piece of the puzzle and the aggressiveness and their ability to translate that technology quickly into a product or feature to help them land larger customers is really helping them out. So one example would be like, there's a huge RFP out. They'll say, oh, Ring and NICE and Cognigy are number 1. Zoom, you can't do A, B, or C, or D. And Zoom will come back and say, oh, I can do A, B, C, and D, and I can deliver that to you in the next 2 quarters. Then the company goes back and asks all the salespeople and the channel people and the service people, can they really do that? And they say yes. So I think that's an untold part of the story is how aggressive they are in R&D, how they've really matured the channel. And then in terms with the R&D, they've also been very profitable, right? So I think that's another thing that's underrepresented and undervalued in the stock.
Now, with the channel, what makes them so good at it, do you think?
Well,
is it their leadership? What's driving it?
Yeah, they brought in they've had fits and starts with the channel over the years. I was rather frustrated with them 3 years ago. In the last 2 years, they brought in a lot of deep expertise, right? The company started out online. Everything was done online. They've now 60% of the revenues from the enterprise. And what they've done is they just retooled the program. What they did is they took everybody out of California a year ago, said, oh, you have to be regionally. If you're going to be a channel guy, you got to be in the region. So they put people in region. They redeveloped their sales portal. They developed how they're bundling a lot easier for pricing, et cetera. So I think those are things that have really changed. And then they've just been aggressive in how many products they have, and they're easy to work. They're much easier to work with than they were almost 2 years ago to move things forward. So I would say the channel enablement, the ability to do these things quickly, access information, bring it forward for an RFP process is really what's helped them out.
It's been quite the transformation. I mean, everybody learned about Zoom during the pandemic. Their numbers spiked, and now people would say, well, it's down, but it's almost back to where it was value-wise for their stock, isn't it? Prior to the pandemic.
Yeah, I would. It's no longer a pandemic stock, right? It's really shifted to an AI story. So it's AI first automation platform, I would say now. And I think that the fact is that they have growing new businesses, they have expanding margin, they're generating a tremendous amount of cash. We didn't talk about the $8 billion on the balance sheet.
We can talk about it right now.
Yeah.
Well, they've raised their guidance for 2026 and a $1 billion buyback.
Right. So I would say my take is that I see multiple growth engines that are firing. So the cohort groups, Zoom Phone, Contact Center, Workiva, and all their other products are actually doing quite well, AI Companion, Chat, etc. So I think if there's a really good setup, and I believe that the valuation doesn't reflect where they're headed. So that's my take on the stock.
All right, Catherine, thank you very much for joining us. We appreciate it.
Thank you.
Catherine Trebnick is a senior research analyst at Rosenblatt Securities. Coming up, Alimentation Couche-Tard shares are getting a boost from an earnings beat and a dividend hike. We'll take a closer look right after the break. Let's see what's driving the markets today, driving trading today. We're joined now by Bloomberg Equities reporter Monique Malima. Monique, thanks as always for joining us. And let's talk first about Fluence Energy having some influence.
Yes.
I didn't say it was a good joke.
They reported earnings. It's a good joke. And they reported earnings for the fourth quarter. Their fourth quarter earnings slightly missed on revenue, but that's just because some of the orders that they were getting, about $300 million, are being pushed out to the next quarter. But why their shares are rising today is that they upped their full year revenue forecast for 2026, and they announced about 30 gigawatts of data center leads and deals in the pipeline, and this is a huge increase for the company. Analysts are saying this is about 80% more than what they had previously, and the company had also warned previously and been a little cautious about whether it would be able to see all the data center demand that some people had been hoping, and now they've been able to show that there is a lot of that demand, that they have those deals coming into place, and that they're going to see growth in revenue going forward. So that's really why there's been such a positive reaction to their shares since they've reported.
All right. Some lumber companies, Canadian lumber companies, are getting some good news today. They need some, don't they?
Yes, so the Canadian lumber stocks are up today. The government of Canada announced yesterday, one of the ministers, that Canada is planning additional financial support for the industry that will be announced later this week. This is an industry that's been really hard hit by U.S. tariffs on softwood lumber and on some other forestry products. So this is going to help provide a boost for these companies that have been seeing rising costs as the ongoing kind of trade dispute between the U.S. and Canada over this. So that's really why investors are kind of hopeful for these companies and for these stocks that maybe they can see some more gains going forward.
Good to see. They've been struggling for a while now with all the tariff wars going on. Last one going the other way is Coinbase.
Yes, so Coinbase, their shares are down this morning. They received a downgrade at Argus. They were cut from buy to hold, and Argus also cut their earnings per share guidance for the company as well. Crypto markets have been really struggling over the past few weeks. We've seen the price of tokens like Bitcoin and Ethereum really take a decline, and that also hits the crypto exchanges like Coinbase because that can have impacts on trading volumes or even trading revenues. So that's why we're seeing kind of some of these recent declines and why some analysts are becoming a little more cautious on the company going forward. But the analysts do also note that there are some bright spots. Coinbase has a deal with Circle Internet Group for their USDC stablecoin, and that's seen a lot of uptick as there's been more enthusiasm around stablecoins and more traditional financial companies getting into stable coins and more people transacting in them. So that's going to help Coinbase going forward. But in the meantime, those crypto markets are really weighing on them.
Okay, Monique, thank you for that. Bloomberg's Monique Malima. Well, Alimentation Couche-Tard appears to be seeing signs of a bounce back after reporting second quarter earnings today, and the stock price also reflecting that. For more on it, we're joined by BNN Bloomberg's Lindsay Biscay to talk about it. Some good numbers for them.
Some good numbers, yeah.
Hello.
Yeah, and the stock price now, like I just checked, and it was up almost 5% at the moment. So doing pretty well for that company today. Of course, this is the company that owns Circle K. We all know that convenience store. Profit beat expectations. Revenue did not beat estimates, but many analysts are saying this is the start of something a lot bigger for Couche-Tard, a comeback of sorts, because, of course, this company spent almost the whole of last year attempting a takeover of the company behind 7-Eleven, its rival. That takeover did not happen. So now shifting its focus, maybe looking at other other opportunities. So when it comes to the second quarter net earnings were at $740.6 million US. That's compared to 708 in the second quarter of last year. Total merchandise and service revenues up 6.6% from a year earlier. And the CEO of the company, Alex Miller, says the company also reported same-store sales growth in Canada of more than 5%. And in the U.S., for the first time in 7 quarters, Couche-Tard increased same-store sales growth by 1.2%, which doesn't sound like a lot when you hear 1.2%, but that's actually tripled its growth since the quarter before. So some really big news, actually, coming out of these earnings today.
And some good news for stock owners as well, the dividends.
Yeah, they're raising their dividend by 10%. So now it's going to be at about 1.2%. Again, doesn't sound like a whole lot. It's always been quite low, but raising it by 10% just kind of shows the direction the company is going in when it comes to what they're going to do with their free cash flow. It also bought back almost $900 million of stock so far this year. So when it comes to what the company is going to do moving forward, a lot of analysts are talking about acquisitions. Obviously, there was the big one last year that didn't come through. But the company Couche-Tard has seen a lot of different acquisitions over the years, 75 in the past 20 years. And we've been speaking with people, including you. We're speaking with Peter Hodson today from I2I Capital Management. He was talking about how, as you know, he would like to see Couche-Tard do more large acquisitions as well. Here's more on what he had to say.
Of course, they tried to buy a big grocery store chain in France a few years ago. I wouldn't want to see them do like a giant deal, but they absolutely know the retail environment. They know the customers, they know the locations, they know the geographies. So they could certainly do a small tuck-in acquisition and just run it as a retail store and sort of have some cross promotions and things like that. I think that would work very, very well. And then just regular tuck-in acquisitions on the convenience store. And obviously, the locations can be very helpful if they ever sort of shift to a massive EV charging operation, which I think is perhaps one of the steps they need to take a little bit more aggressively.
Feels like it, yeah.
Yeah, because they have the absolute locations. They just have to utilize those a little bit better.
And lots of goals on the horizon for Couche-Tard as well. The CEO in a call this morning was saying they're well on their way to their goal of 500 new stores in the next 5 years. And since May of this year, 29 new stores globally have opened, right? Because they're trying to expand their reach in certain countries, including the U.S. and Europe. And for any shareholders that might be interested, potential investors, the company will be holding a business strategy update, and that is happening on February 11th.
Okay, Lindsay, thank you for that. BNN Bloomberg's Lindsay Biscaya. When we come back, the market's been shaken up recently, but are the underlying fundamentals strong enough to deflate the fears over an AI bubble? We'll find out when we come back. There are multiple reports that the federal government and Alberta have agreed to the broad terms of a deal to support a new oil pipeline to Canada's west coast. According to the reports, provincial and federal leaders are set to announce special exemptions and political support on Thursday. BC Premier David Eby has opposed the plan. Eby has said he spoke with Prime Minister Mark Carney, who told him the details were not finalized. Shares of NVIDIA are seeing some pressure today. It's off by 5.5% roughly after a report from the a report that Meta Platforms is in talks to use Google's AI chips in its data centers, according to the report in the information, as the article is known. Meta plans to implement the chips by 2027 and may also rent chips from Google's cloud division next year. Investors believe a deal would signal growing momentum for Google's chips and create a long-term potential to challenge NVIDIA's market dominance. Shares of Abercrombie & Fitch are seeing a surge today. The apparel retailer beat on the top and bottom line in its third quarter, driven by better sales in its Hollister brand, as well as higher margins. The company also raised the low end of its 2026 sales and profit targets. Abercrombie says the quarter was also helped by its pullback on promotions and an improvement in prices. And taking a look at the markets, the TSX approaching record territory again. It's up 0.64%. Another good day for it right now. And south of the border, a bit of a mixed earnings or mixed bag down there. We're seeing the S&P 500 up 0.22. The Dow is up as well by 0.73. And NASDAQ is still off, but it's improving its losses. Of course, that's all being driven by NVIDIA. And it has been a mixed day for the markets. Fears of an AI bubble dragging them down last week. But while skepticism lingers, the data suggests we'll continue to see durable expansion supported by fundamentals. For more on that, we were joined earlier by Philip Peterson, Chief Investment Strategist at IG Wealth Management.
We've just released our 2026 outlook, and we've identified 4 pillars that we believe are going to stand up the economy and support growth into next year. And these are monetary stimulus, fiscal stimulus, the AI spending, and then the wealth effect. So it's not just AI. There's everything around it. And we saw that with the third quarter results that most sectors participated. There was only one sector that was down year over year on earnings, and that was the energy sector. Every other sector presented very, very strong earnings growth and surprise to the upside. So this is a good lead-in into next year.
And you're not concerned that eventually the financing will start to dry up for AI until people see sustainable profits from all this investment?
Well, the financing might dry up, and that is something that you're seeing pop up in the news more and more as these large companies now are having to turn to the credit markets to finance some of these AI initiatives. Mm-hmm. But right now, we're still seeing that real money flow through. And so while future investment might start to slow down, we've got a solid core going into next year that we think is going to be very, very supportive. Now, it could be more of a 2027 story where we start to see things turn a little softer on AI because the proof will need to start having to be realized in terms of the investments and then the returns on these investments. But for now, we remain optimistic that the 1 to 1.5% of AI spending going into the global economy as a percentage of U.S. GDP is still going to be fairly solid.
And we hear a lot about this wealth effect whereby households, especially in the United States, when they own stocks, they see the value of their holdings go up and they're inclined to spend. I guess that cuts both ways. If the market did take a big downturn, it would tend to cut into confidence.
It does, but interestingly, the research shows that as a dollar of financial wealth is realized by households in the United States, about 15 to 25 cents of that, or 15 to 25%, is spent. Now, when we see the markets down, it doesn't mean you have an equal decline. Now, I guess it remains to be seen if we were to see a meaningful decline over the near term, what that would do to consumption. But in the meantime, we've had 3 very, very strong years of growth for investors. Think of even your average balanced fund that has delivered double-digit returns over the last 3 years on an annualized basis. This is being realized and being spent by consumers, not only in the United States, but we think in Canada and other areas around the world.
And you note, I think you touched on this, that governments are in stimulus mode, even if the interest rate cuts are coming to an end. Both in Canada and the States, they're talking about big spending or tax cuts.
Exactly. Remember, OB3, or the One Big Beautiful Bill, a lot of those tax cuts come into place at the beginning of 2026, and that is going to be quite stimulative. We think you're going to have a massive extension of the tax cuts for corporations, but also households. If you look at households earning more than $217,000 a year, they're going to see an average tax cut of $12,000. I mean, that's quite meaningful. We do talk about the K-shaped economy, but it's the consumer that's the top end of that K that is most important to the economy and to stock markets.
What kind of stocks do you think will do well next year, Philip? Is it possible to generalize?
Well, we think we look geographically first. And so when we look at that, we are equal weight in the United States. So we still have a positive outlook for U.S. equities in 2026. But we see an extension of the outperformers that we've enjoyed in 2025 continuing on in 2026. So this is the Canadian equity market, the TSX. We think international stocks will continue to perform quite well and outperform U.S. stocks. Additionally, emerging market stocks we think are continued or poised to continue to outperform. So we're overweight Canada, international, emerging markets relative to the United States, but we're overweight equity over fixed income heading into the new year.
Right. Sorry, what was that last thing about fixed income bonds?
Right. So we're underweight fixed income relative to the equity markets. We just believe that fixed income is still attractive, but the returns that you're going to see are about 3-4% for a broad-based fixed income portfolio. And we believe the equity markets can do better. Now, as we look through to the real downside risks of the market, and that's the risk of recession, that tends to lead to deep bear markets, we don't see a significant risk of recession into 2026. And so therefore, we have a much higher probability of continued positive returns for the equity markets that should be multiples of what we can get out of fixed income. That's why we're overweight equity, underweight fixed in our portfolios.
And is one reason to be cautious about fixed income the risk of inflation, or is inflation pretty well under control now?
We believe inflation's under control. So when we model it out over the course of the next 6 to 9 months, both in the United States and Canada, we see inflation settling into its targeted range. So in Canada, that's 2% plus or minus 1. We might see inflation a little bit higher in the next couple of months. That's more math related than real price impact related. And then it's going to ease back down closer to 2% by the middle of 2026. In the United States, here too, we have inflation targeted around 2.5%. So a little bit higher than the Fed's 2% target, but still in line with the historical norm. So inflation is no longer a problem for the central banks. We think that the focus is going to shift more towards economic support, and that's where we see 4 cuts by the Fed next year, only 1 by Canada.
And he was speaking with Philip Peterson, Chief Investment Strategist at IG Wealth Management. Coming up, one investor says markets are in a state of correction over the last few days, and he sees more to come. We'll have more on that next. Some investors say markets are in a state of correction, and there is more to come. We sat down earlier with Mike Vineker, portfolio manager and senior wealth advisor at Propellus Wealth Partners, IA Private Wealth. He says he is proceeding with caution.
Markets were very, very strong without any kind of meaningful correction this year, and that's just not typically normal course. We did have the start of maybe something, as you said, last week. We think we need a little bit more follow through. The market in the U.S. has been very narrow with the tech stocks, very few of them, you can count them on 2 hands, leading the charge. And we're concerned that unless the market really broadens out to more names within the S&P 500, as some people have said, the other 493, and into the more small mid-cap stocks, that you're going to see some more downdraft in selling because of what you're seeing with NVIDIA, Microsoft, and some of the other tech titans that most recently have had pressure.
And you reckon there is a rotation away from the Mag 7 with the exception of Alphabet?
For the time being, yes. We think that Alphabet, we were a little surprised to see how extended Alphabet is. There's certainly some euphoria. First, you had the Oracle of Omaha giving it the check mark, if you will. And then the other day, Mark Benioff, was wowed by Gemini. And now you're hearing about chips. I mean, Alphabet's a wonderful company, but we're value managers and we're looking at these valuations and we're a little bit puzzled. We think it's a little bit too much too fast.
I wonder, at this rate, maybe it already has, but Google looks set to break the $4 trillion US mark.
I think if I saw this morning pre-market, it hit that. I don't know if it traded there during market hours, but I think pre-market it may have come very close. Yes.
Yeah, it's really amazing. And even a few months ago, people thought, oh, well, AI is going to hollow them out. They're certainly close to 4 trillion right now. But people, it looks like they're now seen as an AI winner with the latest version of Gemini.
That's right. And, I think the mistake was people thought that the golden egg of Alphabet, which was search, was under attack. And at the margin, we agree. But, this past March, we entered the position because we thought, wow, everybody hates it as a value manager. That's when you want to buy, when there's blood in the street. It was trading at, 15, 16 times forward earnings. We thought, wow, what a bargain. Now at these levels, I would be concerned that, there's a little bit too much good news baked into this thing.
Okay. Did you guys buy into Google, though?
So we did. We purchased Google in March. And
I see.
Unfortunately for now, we sold out a few weeks ago.
Wow.
So we missed the last, 5-7%. We'll see. But we thought it was fairly valued in the close to sub 300 range. And now I'm seeing it above 300. So, of course, I wish I had kept it. But, we had a 60% rise in 6 or 7 months, so that's pretty good.
And it's a given, it's an axiom of investing, isn't it? Every time you buy a stock, it goes down in the near term, and every time you sell a stock, it goes up.
For sure.
Yeah.
But Bernard Baruch used to say, forget about the first 20 and the last 20, give me the 60 in the middle, right? So we try and stick to that mantra as much as we can.
Looking at NVIDIA here, it's now down 17% from its record at the end of October.
Yeah. Well, that's what happens when everybody gets onto the same side of a trade and gets onto the same bandwagon. I wish we had bought it, full disclosure, we never did. But I think that at this point in time, there's going to be a much steeper correction on this security.
Oh, you think there's more pain ahead for
I
NVIDIA?
think there's more pain ahead because you're seeing the broadening. AMD is starting to be a competitor. Now Google, Alphabet may be a competitor. Intel is getting funding from the U.S. government. I don't know if they can be a direct competitor, but I guess the concern is, will they be able to retain the stronghold on all of these data center chips? We believe not. And if that's the case, then what happens to margins? What happens to sales growth? And is a 30-odd PE warranted?
You reckon there's signs of excess euphoria in the market in terms of credit spreads, people willing to take on risk in the bond market?
Yeah, so if you look at the MOVE Index most recently has been very subdued.
What's that?
So the MOVE Index is a Bank of America index which tracks the volatility mostly in treasuries, right? So the treasury market has been very subdued, but corporate spreads trade typically off of treasury spreads. And so if the treasury spread volatility is very subdued, then generally the corporate market is sort of in the same vein. Now, we are looking at the high yield, or what's typically called the junk market, and we're seeing a little bit of pressure, which makes sense because of the high-profile bankruptcies of Tricolor and a few others. Jamie Dimon making the comment of there's never one cockroach, right?
Yes.
So, the interplay there, but you would have thought that at this point the spreads should widen a little bit, and so we're concerned that there's a lot of complacency in that market right now.
Tricolor being an entity was fueled by private debt and ran into trouble. Yeah. Salesforce, it's interesting. It has been out of favor. People concerned about AI changing that software, changing the software industry. You see value in CRM, though.
Yeah, absolutely. First of all, you gotta bet on the jockey, not just the horse. We think management is key, and management at Salesforce we think is wonderful. Mark Benioff has been a great leader. You look at the balance sheet strength of this company. They've got net cash position. If you believe analyst estimates, and we do, we think they're actually underestimating the force of Agentforce and their ability to create AI agents to help their customers' businesses reduce operating costs. And I think that Salesforce itself may benefit from even more cost reductions within their own organization, which means their margins should expand even more.
And that was Mike Vineker, Portfolio Manager and Senior Wealth Advisor at Propellus Wealth Partners, IA Private Wealth. Coming up, looks like Ottawa and Alberta have a deal to support a new oil pipeline to Canada's west coast. We'll find out more right after the break. Trade tensions between Canada and the U.S. are causing many snowbirds to opt out of heading stateside this winter, and it could even affect travel for American Thanksgiving. CTV's John Venevali-Rao filed this report.
At Toronto's Pearson Airport, this is typically a busy week for U.S. travel, with American Thanksgiving on Thursday. But this year, the lines may not be as long as usual.
I try my best not to go to the States right now. The whole country's in a conflict.
I am not going to the U.S. at all.
Many travelers continuing to boycott travel stateside since relations with our neighbors remain strained. something brought up by several American senators from border states over the weekend as they attended an international security conference in Halifax. Some calling Trump's tariffs a mistake, noting not only the economic damage, but how Canadians are responding personally.
But the deeper problem is the cultural break. The idea that Canadians now don't think of Americans as their friends and their neighbors, but as an adversary.
We're your friends, and we're going to do everything we can to put things back to the wonderful relationship that we've always had with Canada.
The troubled state of that relationship reflected in the latest travel data, showing in October return trips by car from the U.S. were down 30% compared to a year ago, and by air they fell 24%. We caught up with Brian Ireland as he headed off on a holiday to Cuba. He says this year he didn't even consider going to Florida.
Not at all. Not at all. We just try to stay clear there right now. We're not involved in the politics, and we're happy to be a Canadian.
A recent poll found 70% said they'd feel uncomfortable traveling to the U.S. this winter. 65% said they were concerned about new border requirements for long-term visitors, including fingerprinting. Still, some of those U.S. senators remain optimistic the damage to relations can eventually be repaired, with one of them, an independent, simply calling the tariffs ridiculous. John Benavelli-Rouse, CTV News, Toronto.
Well, there are multiple reports that the federal government and Alberta have agreed to the broad terms of a deal to support a new oil pipeline to Canada's west coast. Earlier, we were joined by our CTV News colleague Colton Prale for the latest.
Carney and Smith are expected to sign an MOU or announce the signing of an MOU in Calgary on Thursday. Carney expected to be at the Calgary Chamber of Commerce presenting that day. Now, it's important to note that the sources do say that time is not finalized yet, so you could see some shifting. But even publicly and openly in the last few days, we've heard Carney say that this is close. We've heard the Natural Resources Minister yesterday in committee say this is close. Obviously, Danielle Smith on her radio show said the same thing. I can tell you sources describing this MOU is something not necessarily that's going to get a pipeline, but that will push the pipeline project forward. Crucially, when it comes to Carney's other environmental plans or things that he hinted at in the budget, those also likely to be in this MOU as well. So you're likely going to see the necessity for some sort of tanker ban carve out. There's probably going to be some scrapping of the emissions cap, changes to the industrial carbon tax system, some clarity on the Pathways carbon capture and storage project. I would look for all of those details to be included in some measure or outlined a little more specifically in this MOU when it comes to this pipeline proposal. Interestingly, and one thing that is worth pointing out, when it comes to the tanker ban in particular, obviously this has been a real issue in BC. We heard the Natural Resources Minister yesterday in committee said that the federal government would work to clear any barriers that exist for a proponent of any project, so long as they have the buy-in and support of First Nations and the jurisdiction. That will be the challenge. Obviously, they have shown that they are willing through the NPO and through Bill C-5 to skirt some of the environmental regulations that Justin Trudeau brought into effect. But the buy-in of local First Nations and BC in this case has been not necessarily there at this point in time.
And this is the tanker ban that would that prevents ships above a certain size docking in the north
of Victoria, or north of the Vancouver Island all the way up to Alaska, essentially, is where it limits the flow of large tankers that you would need to ship oil into Asia from a northern BC coast refinery.
Right. And David Eby, though, the Premier of BC, says, I want to be at the table in these talks.
Yes, he does. Now, to be fair to Eby, there has been some confusion about the level of involvement in which Scott Moe, the Saskatchewan Premier, has been in these talks. He said he was involved last week. We spoke to him last night on Power Play. He said he was more of an advocate for this project, that he wouldn't be a signatory, for example, on an MOU should there be one. Still, though, Eby has been quite aghast at the fact that he feels as though he hasn't been properly consulted on this project. We've also seen him change his tune a little bit from something of this project is never going to happen to yesterday, saying that there should be no taxpayer dollars for this project. But if there is going to be taxpayer dollars, there should be a cap. And if there is no cap, then BC should be getting an equivalent amount of taxpayer dollars back. He put that at the $50 billion mark. And so we are seeing a bit of a recognition from the BC Premier that this is an MOU that is likely coming.
Okay, Market Call is coming up next. And today on the show, we have Andrew Moffs, Senior Vice President and Portfolio Manager at Vision Capital. His focus is real estate stocks. And let's take a look and see how the markets are doing, both Bay Street and Wall Street. For the whole, it's a pretty good day right now. We'll focus on the TSX first, and you can see it is closing in on record territory again. It's just shy of that record. It's at up about 0.76%. And pretty much everywhere you look, it is across the board. You can see that they are all doing well now. Everybody, every category is in the green except for one at one point. And so looking good right now. But one of the leaders right now, Alimentation Couche-Tard, we were just talking about it. It is up about 5%. And of course, that is on its news that it had growth in earnings. And now they say they're looking at acquisition targets. We're just hearing this from one of its top executives. That's Chief Executive Officer Alex Miller, saying he was asked a question about potential transactions, says we're engaged and we continue to see quite a bit of deal flow. And that has some people happy right now. The numbers are up for Couche-Tard right now. And south of the border, the big one, of course, people are keeping an eye on, NVIDIA. It is struggling on the news that there's a possible deal between Meta and Google. Meta may spend billions to buy Google's AI chips, and that is hurting NVIDIA right now. Thank you for watching Morning Markets. I'm Roger Peterson. We'll see you back here tomorrow.